Good morning, Richard Calhoun, Creekside Realty, 40 years of selling real estate in Silicon Valley. We're here to talk about the real estate market. We're trying to focus on what's happening with COVID, and so far COVID really has not negatively impacted the real estate long-term at all. In fact, it's probably helped it. Just a word of warning, my graph here, the colors have not been updated from last week. The numbers have been updated, so there isn't going to be much that you're going to pick up. The only really cool area is right here along the Atherton Menlo Park area where they're getting 99.9% of their overbidding. Clearly, that's not bad. The highest area is somewhere around 105%, being the San Mateo North Coast up here, also Cupertino and Sunnyvale, as well as North Valley and Milpitas over here. You can see most of the map is in the red, which means sellers are getting more than their asking price. You can come over here to find out the exact amount in their areas. 100% is no color, 110 is saturated red, and 96.5 is saturated blue. Moving on to frequency of overbidding. Again, the colors have not been updated from last week, but the numbers have. You can see that in some of our areas, we're getting 78% of the sellers are getting more than their asking price, which is about the highest we've had. We've had 90% in the past. The lowest area right now is 29% in Atherton and Menlo Park area up here. You might think still that's almost a third. It's more than a quarter. It's almost a third of the sellers are getting more than their asking price. You might think that's pretty good. It really isn't. Just the way real estate is, even when we're in the worst marketplaces, about 15% of the sellers get more than their asking price. And that's because they've lowered their price. And then people go, oh, wait, they take such a big price reduction. I'm willing to pay more than that. So, it's over the price at the time the offer is accepted. But again, you can see for the most part, these are pretty good numbers. Again, that's why it's in red. Anytime you're getting more than 42, well, at 42.5%, it's no color. Above that, I start shading to red. 75% is maximum red, 20% is maximum blue. So I don't really expect the market to get below 20. So when you're at 30%, 29.9, 30%, that's getting pretty close to 20, and that's why it's blue in color. Again, days of unsold inventory, this to me is the leading indicator. The numbers have been updated. The colors have not been. You can see that the bulk of the valley is red. Saratoga Las Gatos here is white. Once you start playing around with the market much, you realize each area has different speeds. And so Saratoga Las Gatos is typically one of the slower marketplaces. So the fact that it's sitting here at 44.1 days and 50 through 70 is no color, so that's getting pretty close to no color. That's not so bad. Again, this is why the colors are off, because Los Altos up here should actually be closer to no color, and clearly from last week, it's a redder color. Los Altos, Palo Alto is a normal marketplace where I consider 40 to 80 days to be a balanced marketplace. So this being at 47.7 is actually in the territory of a balanced marketplace. The Saratoga Las Gatos marketplace that I was sharing earlier is a slower marketplace, and it's up here at 44 days. Its normal marketplace is basically 75 to 150. So even though the color is indicating that it's a balanced marketplace, it's actually still a buyer's marketplace for that market. But I decided to use the color scheme uniformly instead of trying to adjust it for each micro market area. Clearly, there's a little issue here that popped up. I'm going to go back and try to figure out what happened, but the data the last couple days has been accurate. Right here, this vertical line, this axis is the 5th. That's last weekend. Last Saturday, this is this Saturday. So Monday's data was off for whatever reason. This is the first time I'm seeing the graphs. I will go back and look at it. So basically just go from here to here, go straight through the big blob. So you go from here down to here. So again, this is days of unsold inventory. This is each one of the micro market areas. It's hard to see, but what you're really trying to look for, at least what I try to look for, is on the right-hand axis. Are these lines going up or are they going down? Basically flat, in my opinion. So, that's a good thing. That's indicate the market's stable. If they were going up, then the market would be slowing down. And if you look at like these bottom couple long-term, they've been going down. You look at this one long-term, it's been going up. So there's been some movements in the different micro market areas. Now we're looking at days of unsold inventory, and the gold line, the sort of orange line, I'll call it orange, I guess, is the 5-year median. The blue line is this year's data. So you can basically see this year's data is right on top of last year's. It's a little below, which indicates we're a little bit of a hotter marketplace. So basically, shelter in place happened here in week 10. That caused the huge slowdown. DUI increase, which is a slowing marketplace, got all the way up to 80 days. Now it came right back down so right about week 24, it's been basically normal all the way up to we're now in week 49. To have a completely normal year compared to the last 5 years, 15, 16, 17, 18, and 19, which were all strong 5 years, is pretty amazing. I've added in what I consider the three major components. So I'm looking at a ratio between this year and last year. The blue line is available inventory. So you can see we've been historically, since shelter in place, been right at 100% of normal. You can see starting here in about week 39, we started growing. And right now we're in week 49 and we're probably about 125% of the normal inventory. So we actually have more inventory than we normally do. And so people that are saying we have a lack of inventory, it's really not a lack of inventory. What we're actually having is more buyers because the holidays are taking a respite this year because of shelter in place. And so the buyers are all over the place and looking for everything that's coming on the marketplace. So there's more buyers versus a lack of sellers. The next line here, sort of this golden rod line, is the number of new sellers coming on the marketplace. And you can see it's been basically normal. Normal would be right here at 100%. Then basically starting in week 37, we started getting more and more sellers than we've had. Then we got way up. And this is because normally we're slowing down at this time of the year. And as I was saying, holidays aren't impacting the marketplace as much this year. And so we're still above, but we're finally kept going down a little bit. So this last week, we've only had 140% of the new listings. So if you normally have 200 new listings come on the market, you've had 280 listings coming on the marketplace. So there's been more listings coming on the marketplace. But then if you look at the buyer's activity, that's this gray line. And as of last week, it was at 100, and that's almost 160%. This week, it's down to about 125%. So that's why I was saying it's the buyers that have really come out more than anything else. I think that's happening basically because people's needs have changed. They now have children at home that they have to homeschool. They're working from home. They need more space. And I think that's causing a lot of people that were on the fence about moving to get up and move, which is why we're having more buyers. Now we're looking at the number of active listings that do not have an offer accepted. So this is what my definition of active inventory. Some people, including the MLS, include offers that are on the market that have an offer accepted, but are looking for backup offers. They don't count because there's a primary buyer. And until that primary buyer goes away, the new buyer can't come in. So it doesn't count in my book. So same concept. The blue line is the raw data for this year. The orange line is the 5-year median. Clearly, the blue line is above the 5-year median. So that says that we have more active inventory than we normally do. So what do we normally have? We normally have about 1,250 listings. We have almost 1,700 or somewhere around 1,700 listings. So that is quite a few more listings than we normally have for this time of the year. Now we look at the number of new listings in a given week, and it's hard to see week 50 is 0. So it's hard to pick up the data point, but I think it's about here versus here. So you're still above the number of new listings. You can see the drop down this year on the blue line is following, including the little hiccup here, which was probably Thanksgiving. And that shows you the impact that every holiday has. But the drop off was delayed and so far hasn't been as much. It looks like it's starting to catch up. And maybe by Christmas time, it will be pretty normal. But again, this is not a bad curve. And that's the number of new listings coming on the marketplace. This is the number of new offers accepted. And you can see you had a huge deficit here when shelter in place was first announced from week 10 through about week 21. And then basically once you got to about week 31, you started selling more listings than we've had. And again, what I'm comparing this to is the 5 years of 2015 through 2019, which were all 5 good years. And we're outperforming those 5 good years. And this is at the macro level, which is San Mateo County, single family homes, condos, townhouses, as well as everything in Santa Clara County. So it gives you a global idea of what's happening. Now you're looking at the frequency of overbidding. This is how often are sellers getting more than their asking price. And you can see that's coming down the last couple of weeks on the right side of the graph. We're now at basically, it looks like 55%. So 55% of the sellers are getting more than their asking price. Now that could be $10 over the asking price, or it could be $1 million over the asking price. It's just the frequency of getting over their asking price. This is each one of the micro market areas. And again, it's hard to pick up with much of this, but what you're looking for is this trend up, is this trend flat, or is this trend down? And basically, for the most part, the trend appears to be fairly flat. So you're not really having a change in the frequency of overbidding. The red line up here is the single biggest one, which is Santa Clara County, the whole county, all single family homes. You can see that trend has been basically going up. And then basically since call it Thanksgiving, it's been fairly flat. Now we look over at the magnitude of overbidding. Magnitude of overbidding is how much are the sellers getting above their asking price. Right now, you can see there was a fairly significant drop this last week. Last week, they were getting 103% above their asking price. And this week, they look like they've dropped down to 102% of their asking price. So they're still getting more. There's been a whole percent drop. But now remember, because it takes about 5 weeks to close escrows, this is activity that happened 5 weeks ago. So this drop was going into Thanksgiving in all reality. But you can see the huge slowdown after shelter in place. Again, this is not as dramatic because escrows are different durations and time, and it's delayed. So shelter in place is the purple vertical line at week number 10. You can see that originally it was flat, but those are escrows that were essentially already closing. And then it started petering down. Then we slowly just came back up. We were about 103% all the way from week basically 39 all the way up to week 47. Then this last week, week 48, we dropped down to 102%. Here's each one of the micro market areas. You can see Santa Clara County was growing and it's come down just a little bit. Some of these other micro market areas have dropped more. This micro market area dropped fairly significantly way back here at the beginning of November. I believe this is going to be your expensive areas in San Mateo County. Here we're looking at the overbidding. This graph is the weekly data, so this is macro. So I'm looking at only the activity that closed in the last week, ending last night at midnight. You can see right now we are the lowest line on this graph. So that really has changed from just even last week, where I think we were the second best. But we're getting right to Christmas, and this is going back all the way to September. So we're not comparing the same week, which is important because there's a huge annual cycle, but we're comparing what the market has done over the last 12 weeks. Now we're doing the same thing, but we're going even further back. We're going all the way back to July 31st, so the end, beginning of August. So August 1st all the way up till now. And again, you can sort of see we're at the bottom of the pack. This is indicating that the amount of overbidding has been dropped down. People aren't feeling as much pressure to buy. These outlying lines here, this is going to be the best December ever, which was December of 2017. This is the best month ever, which was April of 2018. The worst month and the worst December both coincide in December of 2001, which is why it appears there's only one blue line. There's two blue lines on top of one another here. So this is the worst we've ever been. This is the best we've ever been in a December, this one here. And right now we're at this red line. We're sort of towards the back, but now, so these outer lines, we're sort of comparing what the range is for this time of the year. This inside ones, we're just comparing the last 20 weeks. Same concept here, but just not as many weeks. And now what we're actually doing, instead of weeks, we're looking at years. So we're actually changing a little bit. This is macro data. This is starting on December the 1st. Going through January the 4th for each one of these past years. So this is this year. So now we're comparing season to season. This is the best year back here in December of 17. We're not showing the worst year in this because we're only going back to 2009. And I said the worst year was 2001. But you can see comparing this year, there's 17, which was phenomenally good. Then there's 2 years that were right on top of one another. And then this year is basically tied for fourth place. So, and if you want to, I guess in races you count it, so that's fourth, fifth, and sixth. So you have several that here that are all grouped together, but we've also had some very good years. We're outperforming 2019. We're outperforming 2018. Those were 2 out of the 5 good years I was doing the comparison for. So we're really not doing that bad. Now here we're putting in more years. We're going all the way back to 1998. I show 97 in the data, but it's not on the graph. You can see the red line, which is the current line. We're basically, I'd call it the 4th best year. So out of the last 20 4 years, I think, is up there, something close to that anyway. We're in the fourth best year. You cannot complain about that. So I just want to make sure I'm clear on this. Even though the market is slowing down in those several last weeks, that's because there's a huge annual cycle in real estate. So you have to compare the same week year after year after year, which is why I've broken it down to the years. So fourth best year, that's not bad at all. Now we're back to colors, and this is price. This has not been updated at all since last week, which is why on December 5th, 2020 date is up here. Prices don't change very much, but the purpose of this slide is to show you where you can find affordable houses. The bluer the area, the more affordable the area. The redder the area, the less affordable the area is. This is today's data. So this allows you to go and find single family home data in Santa Clara County for anything that you're interested in. You can see right now we have 17 days of unsold inventory in the entire county. On average, they're getting 103.6%, and 68% of the sellers are getting more than their asking price. The cheapest 10% homes are at 900,000. The median price that most people follow is just under 1.4 at 1.385, and the 90 percentile is approaching $3 million. So you can come back and look at each one that you're interested in. This is San Mateo County, and this is condos and townhouses in both counties. And that's the quick recap. The next thing I plan on doing is going into monthly data, and I'll pause for a minute to see if anyone's going to unmic themselves and ask for a question, or if I'll just go into monthly data. So here is your monthly data. So this is data that would have started on November the 1st, gone for 35 days, 5 weeks. So it would have included data through December the 5th, which is why this is the first weekend we can talk about it. What you're looking at here, just several things. The asking price at 1.8 million, you go, wow, that's way up. What it's really saying is some of the more expensive areas where commute was convenient, they're not doing so well right now. So they're staying longer on the marketplace. So they're making up a larger percentage, which pulls that up. You can see at 664 inventory, we had less inventory than we did before. You know, some of what I'm saying now may sound contradictory. What we were talking about earlier today was the entire micro market area, San Mateo, Santa Clara County, condos and townhouses, as well as single family. Now we're talking about monthly data. Monthly data only talks about single family homes in Santa Clara County. That particular micro market is what's doing the best out of the macro market. So that is why now it's 664. We have less inventory than we normally do. You can see, yes, there was one year, 2017, where we had fewer single family homes for sale with less than 500, 486. You know, so you have to keep up with me, and sometimes I get ahead of myself. That's why right now we're having very limited inventory in single family homes in Santa Clara County, because this is a hot marketplace. You can also look at the makeup of what the houses are on size. Then you come down to offers accepted. And the colored lines are the lines that I think are more significant. So the average days on market is 21, the median is 10. So that would say that half the homes are selling in 10 days on the marketplace, and within shelter in place, that's just about as quick as you can sell a house. In fact, I've had a couple houses where, you know, even though I'm finding the listing within hours of it hitting the MLS, every listing appointment's taken, including one today, where it was sort of interesting. They were only opening up 32 time slots for potential buyers to look at the house before they were going to look at an offer. You know, that's not a whole lot of buyers in there, you know, because in a single open house, you used to get 50 people through. So don't know what's going to end up happening on that. Just a little interesting thing. But if you look at the time on the marketplace at 21 and 10 days, you come back in 17, which we were talking about being a phenomenal year, was 20 and 10 days. So that's almost right where we were. Then if you look at DUI, is at 23 and a half days. Back then it was at 21.5. So that's why, you know, DUI is a more sensitive indicator. So with DUI, you're seeing that this year is a little bit slower than 2017 was, but you can basically see that is the second best year when you come all the way back here. You can't find another year back here with a lower DUI than 23 and a half. So we're having the second fastest paced marketplace ever for single family homes in Santa Clara County. Median list price of what got accepted is at 1.3. So then if you come back in 5 weeks and look at what the median sale price is, then you can start getting a sale price to list price ratio. We sold 28.2 homes. If you come back and look, you can find higher numbers back here starting in 2012. But one of the things that you'll notice is all the numbers back here are much higher. One of the things that has been happening is the volume of transactions have been going down. And that was sort of part of CAR's motivation of doing Prop 19, in my opinion, was to get this volume of transactions back up so there's more commission dollars for the industry. So it was sort of self-serving in a lot of ways versus helping out individual people in their retirement planning. But at 99 and basically almost 1,000 homes for this time of the year, that's pretty good because you basically have to come back here to 2012, as I said, to get more inventory. Then what you have is the update number, and this really isn't that significant, but you can see I had a negative TFT ratio. And how does that happen? We're so close to December the 5th when this data happens, there's still more late reporting sales, so the sale number is increasing. But as time goes on, there will be no more late sales and there will be more TFTs. And so you can see the number will go slightly negative. And that's just to give you an idea of what percent of the marketplace isn't getting captured by late reports and by TFTs, because I don't come back and recalculate these numbers. I would go crazy if I tried to do that. And again, you have the description of the typical houses in the terms of square footage, bedrooms and bathrooms, and then you get down to closings. So at this time of the year, we're talking about having the second best year as far as DUI, but now look at the overbidding. You're at 103.7%. You go back to 2017 and they were 108%, and you don't have any other year, I don't believe, that's there. So again, even though we're close on DUI, we're nowhere close in the magnitude of overbidding. And one of the things that I've observed is anytime there's been an insult to the marketplace, buyers are more conservative and they're not willing to overbid as much. And if you look at the frequency, we're at 67.5%, that's pretty respectable. You can't find any year back here that has a higher number other than 2017, and it was basically at 78%. So that's why you're starting to see such a difference. And that was why that sale price to list price curve was so far pulled up, even though when you look at DUI, they're fairly common. They're very similar. And then if you look at the pricing here, you're going from basically $900,000 to $3 million is the price range, with the median being just at about 1.4 million. Oh, what's the difference? Sure, that's a great question. DUI, you look at the inventory and then you calculate your rate of sales by what's sold in the last 5 weeks or the last week. So if I'm doing macro data, I only look at the last week. If I'm doing the micro market data, I look at the last 5 weeks. So you determine on how long it would take to sell your existing inventory based on the sales volume for that 1 week or 5 week period of time. Median days on market is simply how long the listings have been on the marketplace. So they're related, but they're not the same. People understand days on sold inventory. The most common metric that's quoted is average days on market. But average is really misleading, just like average sale price, because you get one house that was on the market because it was an overpriced turkey for a year. It will bring up your average, but won't impact your median. The other big thing is median days on the market has a lag time, because the market changes on a dime, and it really does change on a dime. Median days of unsold inventory takes time to increase or decrease, where your sales are impacted immediately if there's a change in the marketplace, and so your DUI changes more rapidly. So the way to look at it is they're all measures. Average days on market, median days on market, DUI are all indicators of the speed of the marketplace, but the most responsive and the most instantaneous one is days of unsold inventory, followed by median days on market. So on this graph, we're showing all three things. So the DUI is this blue line. So you can see it's in between the average and the median. Here it's above, and above. And I think that's the general trend. If DUI is increasing, it leads. Then here you can see the huge decrease in DUI. So the decrease in median days on market didn't happen until later. You can see DUI was increasing again. So you can see the lag factor right through here, because here's the sawtooth on DUI, that same sawtooth on median days on market is lagged by almost 2 months. Well, actually by 6 months, because this is going to be about July of 2017, and this is January of 2017. Here you can, and here's another thing where they differed. Here DOM fell straight down, where DUI went straight up. Why was the difference? The MLS froze days on market at 0. They stopped counting them. And so we got down to the point where half the homes that were selling were listed during shelter in place. So they were selling with 0 days on the marketplace, but yet you had a huge DUI. So that's another reason. You can see they're all together right now. If I went back in time further, they're not that usually that in agreement, but that's life. This is looking at overbidding. You have two different types of overbidding. Up here, you have the magnitude of overbidding. So in 2017, you can see the huge magnitude was up here. Right now, you can see you're only here at about 100, I think we're at 102% now, but I think this is going to be 103%. And actually, this is closer to 104%. And the reason this is 104%, whereas at 101, I think it was at 102% in macro data. So 102% is macro data. Single family homes in Santa Clara County are at 104%. And that becomes pretty significant when you think about it, because Santa Clara County makes up probably half of the entire macro market. That means that some of your condos and townhouses, if I plotted them out, would probably be very close to 100%. Then here's your frequency of overbidding, and it's hard to pick this up. So this is 65, so I'm at about 68%. So 2/3 of all sellers are getting more than their asking price in Santa Clara County on single family homes. Here is your December data. All the lines on this graph, except for the red line, are macro data for December. What that means is I started on December 1st of the year. I went for 35 days, but I looked at the macro data. The red line is the current data. I'm trying to give us a feel for what that data is doing compared to normal. So it's December 1st to current date macro data. So it's only, at this point, 11 days of data, and it's at the beginning part of December. I don't know if this is going to go down over time or up over time. This is data that I haven't plotted before. So I'm plotting the current December compared to past December, so you can see the annual cycle. And what this is basically saying is we're not having a bad year. This is the same thing going back just more years. And again, you can see that we're somewhere tied for, I don't know how many we want to put together. 1, 2, 3, 4, 5, 6, 7. If you put all 7 of these together and you have one out here, we're tied for 8th place maybe. Or if you say these two are in 2nd and 3rd place, then you're tied for 8th place with 5 other years. But that means there's a whole bunch of years back here that were a whole lot worse. And not a whole lot worse, we're worse, let's say that. This is moving data. And I'm not sure I have a lot of confidence in the purple line, but what this is doing is you can see inventory was pretty high back here in the middle of 2019, and it's been coming down ever since, and it started to flatten out. The number of offers was actually pretty low and is actually increasing, and that's the more activity that we're having. We're probably somewhere, I would say right now, we've been running about 120% of the number of offers accepted that we normally would. Here we're looking at sale price. Most people just follow the median price, which is in the middle here. This gives you the bottom end and the top end. So this is the bottom 10%. This is the top 10%. So you know the range, and it's telling you that 80% of the homes are selling between those two price ranges. So somewhere around $900,000, you can buy a single family home in Santa Clara County. And this is $1 million, $2 million, $3 million. So somewhere around $3 million, you can pretty much buy any single family homes. There is 10% of the market above $10 million, above $3 million, but 10% of the marketplace is not that significant. This is what you're more used to seeing. This is an analog. So again, it's easier to pick up the numbers probably. This is 800 down here, I think, and this is going to be $1 million. So yeah, 900 was a pretty good accurate estimate. Right now, you're pretty close to 1.4. And I think one of the numbers I read off earlier was 1385. And then here you're pretty darn close to, it looks like we're close to 2.8. No, we're real close to 3 million. So that just gives you the reason I do the semi-log on the previous graph is that gives you the slope of the line, gives you the rate of appreciation. This graph Just shows you that right here before the mortgage meltdown, we were having some price compression. The blue line and the pink line were coming together, and then they spread apart where you had price expansion, and we're coming together again a little bit with price compression in the current time frame. You get this by just doing the 10 percentile ratio between the 10 percentile price and the median, and then the 90 percentile and the median, and then plotting them. This is the median against itself, which is always equal to itself. With that, I've made it through the monthly data, and I'll pause for any questions. And if we have no questions, I'm done for the day.